Another mode of financing, what we call debt-based financing mode. So we said we have two profit and loss sharing modes, which is Murabahah, which is Musharaka and Mudaraba. And then we have a debt-based, which is non-profit and loss sharing modes of finance, which is Ijara, Murabahah, and few others. In the case of Murabahah, this is the most simple transaction. It simply means you sell something at a markup, at some profit price, and it is very similar to the normal sale. So all of the rules of the sale would apply to this particular transaction. Since Murabahah is a type of sale, sale in Sharia is defined as the exchange of things of value by another thing of value with mutual consent. So when you go and you give money to buy a car or a home, you are engaging in a sale. And when you engage in a sale, you immediately transfer ownership for the payment. And even if that payment is not on the spot, immediately effect of sale is immediate. Some of the rules regarding the sale: the subject matter in a sale must exist at the time of the sale. You cannot sell something in this particular arrangement. Another mode of financing, what we call debt-based financing mode. So we said we have two profit and loss sharing modes, which is Murabahah, which is Musharaka and Mudaraba. And then we have a debt-based, which is non-profit and loss sharing modes of finance, which is Ijara, Murabahah, and few others. In the case of Murabahah, this is the most simple transaction. It simply means you sell something at a markup, at some profit price, and it is very similar to the normal sale. So all of the rules of the sale would apply to this particular transaction. Since Murabahah is a type of sale, sale in Sharia is defined as the exchange of things of value by another thing of value with mutual consent. So when you go and you give money to buy a car or a home, you are engaging in a sale. And when you engage in a sale, you immediately transfer ownership for the payment. And even if that payment is not on the spot, immediately effect of sale is immediate. Some of the rules regarding the sale: the subject matter in a sale must exist at the time of the sale. You cannot sell something in this particular arrangement where the delivery is uncertain or there is some issues with the existence of this asset in this particular situation. The subject must be in the ownership of a seller at the time of the sale. You cannot sell car which you do not own, for example, at the time of the sale. So that would not be valid because, again, you cannot guarantee that you're going to get it, and specifics of the car might be in question later on and so on. The subject of the sale must be in your possession, whether it's physically there or some sort of constructive possession, where you have taken this physical delivery of the commodity and it has come into your control with all the rights and liabilities that comes with this. And the best way we know this is whether the risk of destruction came to you. So for instance, we could say that if somebody sells you a car that is in a public garage with free access, then that concludes transaction. If that car is locked in my garage and I conclude the transaction in terms of documents, and you don't have access, uninterrupted access, well, that is not a valid contract. You did not take proper ownership of this car, and therefore you cannot sell it then. When we execute a sale, as soon as you sell something, that transfer of ownership of the asset is instant and absolute. So we cannot say in a contract of sale that it relates to time or a period or some condition and so on. Once you sell, then that's it. There is instant transfer of ownership. The subject of this sale must be something, again, like in any other contract, of value and must satisfy all of the usual condition. It must be known, identifiable, and very clearly identify. So, for example, if you are selling apartments, you cannot go and say, I sell you one of these apartments. So we don't know which one you're selling. We have to know this specific one. In terms of delivery of the commodity, we must be then also certain that we can deliver, that the commodity is clearly identified, it has a certain price. We cannot sell something where there is uncertainty in terms of the price. For instance, in a lease, we said because we own asset and we are leasing, we could change the price if we agree on certain mechanism from the beginning. And because we are leasing that usufruct, we could change that as throughout different periods. But once we sell asset, we cannot change the price. It cannot be variable, because once you sell asset, you receive payment, or if it is not on the spot transaction, if it is deferred payment, it is something that is coming, and now we cannot change that amount. So in the sale, always the price is fixed. So for instance, if the person would stipulate condition where they say, I sell you a car for $1,000, if you don't pay me the car in 1 month, then it becomes $2,000. In this case, what would happen is the first transaction is permissible. I mean, the whole contract is not permissible if we phrase it like that, but from just a purely identifying that transaction, first transaction would be sale of asset for a price, and then second transaction where they increase that debt of 1,000 for a 2 would be interest, because the subject matter in the second transaction would be debt or the money. And the sale must be unconditional. If we put certain conditions that are not customarily found, then this would make sale as invalid. So for example, somebody buys a car from a person and they put a condition that they will employ their son in his firm. So this would be obviously something that is invalid. Now, when we come to the Murabahah and sale on a deferred payment basis, the scholars agree that deferred price may be more than a cash price, but it must be fixed at the time of the sale. So we could have a price for the cash, and we could have a price if person is paying as in installments, for example, and there is no problem as long as we fix this from the beginning and we know which price we are going after. We cannot leave these two options and buy while keeping both of these options, or say if you pay by this date, this is how much, if you pay by that date, this is how much. So as long as we agree at the end on the one price, this becomes a process of offer and acceptance and negotiation, and we agree on one price, one set of conditions, this is valid sale. We cannot have multiple price points that become available as the time goes. So once the price is fixed, it cannot be changed. Just like what we mentioned in lease, if there is a default or something like that, we could have like what we call like penalties, where one party donates specific amount to charity. So sometimes this is necessary, sometimes it is not. You have to make a judgment. Obviously, when people are late, we would like to give a respite and offer this sort of assistance, but sometimes people might get just lazy, and you want to have incentives to make sure that people are paying on time. In all of these situations, it is permissible. Seller may ask the buyer for some kind of a security in case of non-payment or default, where they can sell something, and in that case, they can sell that asset and get the money back that they invested or that they are waiting for. So Murabahah is the cost plus sale. Then the most basic way it works as a mode of financing is let's say a bank or financial institution would like to engage in the transaction with the customer, where customer wants to buy a car. Now the customer does not have money, and they would like to finance this car and pay in installments. Once they identify the car and once the bank purchases the vehicle, so bank would take the ownership of that particular asset and pay. Usually banks, they don't have a cash flow problem, so they would pay on the spot, let's say 20,000 for the car. They would take ownership of an asset, and then they would offer the car and sell the car to the customer at the markup, at the profit. So in this case, let's say bank buy for 20, they sell for 30. This is a profit for the bank. Bank engage in the transaction. Is this the same like your personal financing at the bank and interest-based? Some people might think just because there is a profit involved that it is the same, but as we said before, a bank here is making money by buying and selling some asset. As long as they satisfy the rules and all of the other conditions of the valid sale and so on, it's a genuine and so on, this is something that is permissible in Islam, and this is in reality how most of the businesses today work. They would buy something and sell it something at profit, and that there is no problem. And of course the customer benefits from installment payments that are available. So this is how Murabahah in a more simple sense would work. Of course, sometimes we have to look more closely how exactly this is done, in a sense how we take ownership, how we price this, how we calculate it, how we account, all of these things we need to analyze sometimes in more detail, but this is the basic idea of it. The benefit of Murabahah is that while it's not, again, mode of financing in the original sense, it is something that helps us really to escape from the interest and dealing with interest-based financing, and it provides us with the alternative. It is different from the loan because subject matter of the contract is not money but the asset itself, and it is permissible again to sell asset at a profit, whether that profit is paid on the spot or in deferment or in installments. When it comes to institution, the way they put the process together, sometimes there are some differences. They make maybe the client as an agent who identifies the asset, buy it maybe on behalf of the bank, and then they sell it, and then banks sell it to the customer. And there are a number of different ways that they go about this. Sometimes you might have a situation when institution might already own this asset. I was just actually working with the customer just now. They have 7-8 car yards, and they own the cars and they're selling, so they don't, the customer come and just pick the car, whichever one they want. So there is a number of ways this can be organized, but the most important thing here is to look for a genuine transaction and so on. Sometimes in different jurisdictions you have to follow the rules of law and engage lawyers to organize, like with all of these transactions, to make sure that you are compliant with the law and Sharia and everything else. The benefit of the Murabahah for the company is that once they sell the car, all the rights and liabilities are passed to the owner, new owner, regardless of the fact that they are paying in installment. As we said, the sale is such a contract where the ownership passes immediately. Unlike lease, where you keep, if you are an institution, you keep certain ownership responsibilities. And this is sometimes not an easy. As we all would like everybody to behave ethically, you might have sometimes institution or a customer that might not have the most ethical behavior or arrangements. So Islam wants to make sure that it protects the society and ethics and the wealth of people, whether they are individuals or organizations or a group of individuals. There is often lots of talk about Murabahah and sometimes the misuse of Murabahah. There are some more complex instruments and more controversial instruments where Murabahah might have been structured in the wrong way. Just like anything else, you can structure it in the right way, wrong way. Sometimes there is limits how much you can go, whether it's a partnership or lease or a sale. And Murabahah is often in the headlines the very much misused in number of the ways, especially when they combine some other transactions where people put arrangements that might be seen as synthetic in nature and not a genuine trade. So this is the job of Sharia scholars, to make sure that everything is transparent and clear and it's genuine. And just like in Ijara, there are some issues with Murabahah, and that is primarily penalty in case of default. As we say, this is interest. However, if there are some genuine costs, legal costs and fees that Sharia scholars analyze as genuine, judged by the customary practices, the real costs, and preferably even third party, then it's something that could be looked into. Murabahah is such an instrument where once you sell, the customer owes you money. There is a debt now between you. One of the biggest challenges is how do you rebate, how do you discount that debt in case of early payments. And this is why sometimes the customary practice is usually to forgive a debt, but you have to structure it, put it in a way that it is not part of the main contract,